Let's delve into the insightful analysis of Ray Dalio as he explores the reasons behind America's dreadful financial crisis. Join us on this deep dive into economic landscapes as we unravel the key factors that contributed to one of the most challenging periods in recent financial history. Stay tuned for a comprehensive exploration of Dalio's perspectives and the lessons we can draw from America's financial turbulence. Let's jump into the intricacies of this compelling discussion. Dalio has often expressed concern about the possibility of a balance sheet recession and big cycle debt crisis in the United States. Let's examine more closely at the particular causes of America's unstable financial status that he mentions. Dalio draws attention to the U.S.'s substantial increase in both public and private debt over the previous few decades. This includes the worrisome rates at which family, state, municipal, and federal debt are growing. People with such high debt loads are more susceptible to interest rate increases and other economic shocks than are the government. Dalio contends that firms maintained afloat by inexpensive debt rather than profitability, referred to as zombie companies, have been supported by easy money policies and low interest rates. This further deteriorates the long-term economic outlook by distorting the market and discouraging investment in profitable industries. Excessive debt and low interest rates, in Dalio's opinion, contributed to speculation and asset price bubbles, especially in real estate and stocks. This improper capital transfer from profitable ventures increases wealth disparity and makes more people susceptible to financial shocks. He thinks that the U.S. is progressively losing its position of power in both geopolitics and the economy. The dollar and the United States' influence on the international scene are weakened by the growth of China and other emerging economies, as well as by American policy errors. Deep political division and internal strife, according to Dalio, make it difficult for America to handle pressing problems like the country's debt and deteriorating infrastructure. This impasse prevents long-term planning and investment and breeds policy uncertainty. Dalio cautions that a lot of people, corporations, and even the government won't be able to handle the pressure of paying down their enormous loans once interest rates eventually rise. This might lead to market collapses, defaults, and an enormous financial crisis. America's pre-existing vulnerabilities could be made worse by outside forces such as trade disputes, armed conflicts, or interruptions in international supply lines, which could lead to a crisis. In order to attain fiscal sustainability, Dalio suggests making large reductions to government expenditure and raising taxes. Additionally, he advises careful budgeting and debt reduction on an individual basis. He is an advocate of diverting funds from speculative activities to worthwhile endeavors like infrastructure, education, and R&D. Long-term economic growth and competitiveness would both benefit from this. Dalio urges political change in order to lessen division and boost effectiveness. He also emphasizes policies that address wealth inequality and create a more equitable society. In his stark assessment of America's financial destiny, Ray Dalio draws attention to the risks associated with high debt levels, internal conflict, and a deteriorating position internationally. In order to solve these problems and get ready for any economic shocks, he suggests taking quick action. Even though Dalio's suggestions may not be widely accepted, his research provides insightful information and provokes thoughtful consideration of the U.S. economy's future. One of the wealthiest investors and businessmen in the world, Ray Dalio, has examined the causes of the financial crisis in the United States in his book, Principles for Navigating Big Debt Crises. During the 2008 financial crisis, Dalio's company, Bridgewater Associates, was able to foresee developments and generate notable gains by applying his special framework for comprehending how debt crises operate. Prominent individuals like Larry Summers and Hank Paulson have praised and paid heed to Dalio's predictions and insights. According to him, it is essential to comprehend the past cause and effect linkages of intricate economic circumstances. Based on past trends, he has forecast the U.S. economy and issued warnings about the potential for yet another financial crisis. He has voiced worries about the United States' excessive borrowing, the slowdown in economic development, interest rates, civil unrest, and geopolitical issues. In addition, he has emphasized the dangers of the nation's spiraling debt, including the possibility of a debt crisis and the meaningful slowing of the economy. According to Dalio, the US economy is in a bubble because of the Federal Reserve's low interest rates during the epidemic and the extensive stimulus plans, which significantly increased public debt. He thinks that the markets will eventually suffer as a result of the central bank's attempts to burst this bubble by hiking interest rates. Furthermore, Dalio has highlighted the persistent divisions between the political parties of the left and right in the United States, which have contributed to a wealth disparity and social disasters not seen since the early 20th century. The examination of the American financial crisis by Ray Dalio sheds light on historical trends and possible dangers that could result in financial catastrophes. In his book, Principles for Navigating Big Debt Crises, he provides a framework for comprehending and handling financial difficulties. Even if Dalio is an expert and has a solid track record, his projections are nevertheless worth taking into account when examining the state of the economy today. Ray Dalio presents an incredibly straightforward theory of the economy that centers on transactions. A transaction is any economic exchange, ranging from grocery shopping to stock investment. However, beneath this simplicity is a more profound comprehension of how credit, money, and debt interact to form our financial environment. The purchase comes first. A purchase of a product, service, or financial asset is the fundamental component of all transactions. Money can be used to make this transaction, signifying previously acquired and exchanged value. Cash or credit. The transaction concludes neatly when money is exchanged. You have fulfilled the exchange of value and are free to leave. But when you make use of credit, something new shows up. Liability arises from credit. Even though you've already benefited, you still need to pay to complete the transaction. This creates a debt, essentially an IOU to the lender. Debt, friend or foe. Despite being criticized a lot, debt is a useful instrument in an economy. It permits entry. Economic growth is fueled by people and businesses having access to goods and services they might not have the immediate means to purchase. Borrowing can support investments in profitable endeavors, yielding returns on debt in the future. Additionally, credit acts as a safety net, enabling us to take advantage of opportunities and weather unforeseen costs without exhausting savings. But debt must be used responsibly, just like any other tool. Overborrowing can be problematic as it can result in defaults and unstable economies. Interest is a cost associated with debt or the price of borrowing money. In addition to adding to borrower stress, high interest rates may further hinder economic growth. Growth and social mobility can be hampered by unequal access to credit, which can exacerbate already existing disparities. Navigating the complexity of the economy requires an understanding of these dynamics. Understanding the function of transactions, the difference between credit and money, and the advantages and disadvantages of debt enables us to make wise decisions for ourselves as individuals and as a society. Further insights from Ray Dalio illuminate the deeper aspects of credit, demand, and exchanges. Let's explore these ideas in more detail. Investing, Dalio contends that it is incorrect to evaluate demand only by looking at the amount of things produced. Rather, demand is better captured by the entire quantity of credit and money used or the transaction's value. This method takes into account people's desires as well as their ability to obtain them. Credit, fuel for demand. Credit is a key factor in determining demand. It lets people and companies make purchases that exceed their available funds because it offers an option to instant payment. This increases the number of possible customers, increasing demand, and having an impact on the economy. Credit cycles cause economies to alternate between periods of expansion and contraction. Credit creation rises throughout a boom, boosting economic growth and expenditure. Uncontrolled credit growth, however, can result in bubbles and eventual crashes, causing intervals of contraction and debt repayment. The velocity of money that is already in circulation doesn't determine whether credit is created, despite what the public believes. Banks have the ability to create credit out of thin air by issuing loans that are based on their reserves, which is the equivalent of creating new money. Growth in the economy is mostly driven by this capacity to increase purchasing power through borrowing. By concentrating on spending rather than just quantity, the real picture of demand is revealed. You ought to understand how crucial it is to manage your credit responsibly. If you enjoyed this video, don't forget to hit that like button and subscribe to stay connected with our journey through the world of innovation. Feel free to share your thoughts and comments below. We'd love to hear from you. Stay tuned for more exciting insights into the world of technology and innovation.